Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 February-March Paper 2-2. This is the Paper 2, which consists of 4 questions, 2 of 30 marks and 2 of 15 marks. And the total time limit for this paper is 1 hour and 45 minutes. Since question number 1 is of 30 marks, ideally you should be spending about 35 minutes in order to complete this question. And in this video as well, we'll be attempting to solve this question under 35 minutes. So without any further delay, let's get started. The following trial balance was extracted from the books of V Limited at 31st December 2023. We have 8% debenture, which is to be repaid in the year 2029, administrative expenses, bank loan interest. We have the carriage inwards, which will go in our cost of sales section, and the carriage outwards, which will go towards our selling and distribution costs. We then have cash and cash equivalents, distribution costs, dividends paid, furniture and equipment at carrying value. So this is our net book value at the opening date, which is of 1st January 2023. We then have the inventory at 1st January 2023. This will be our opening inventory. We have property at valuation. Then we have purchases, rental income, retained earnings, returns. And in this case, we can see that the returns is on the credit side. And if it were the returns on the debit side, that would have reflected our sales returns. And since this one, 5,100 is on the credit side, this will reflect the purchases returns. Then we have the revenue, share capital. We have a total of 4 million ordinary shares and the nominal rate is 0.25 each. Then we have the share premium, trade payables, trade receivables, wages for office staff. This will go towards the administrative expenses, and the wages for sales staff will go towards the distribution costs. Then the following information is also available. At 31st December 2023, inventory was valued at 49,500. So this is the value for our closing inventory. Then distribution costs include a prepayment of 6,000. So this inclusion of 6,000 is for the prepayment at the closing date. And the closing prepayment is always to be subtracted because this 6,000 is the expense for the next year, not the current year. So let's subtract the 6,000 from our distribution cost, which is right here. We'll subtract the 6,000. Okay. Then at 31st December 2023, rental income of 3,000 had been received in advance. Again, the same thing as above, but in this case, we're talking about our income. But still, this 3,000 is the income in advance, which means that this 3,000 is actually the income for the next period, which is why we need to subtract it from the rental income for the current year. So the rental income is right here. That's 13,300, out of which 3,000 is the income received in advance. Then provision should be made for depreciation of furniture and equipment at 20% per annum using the reducing balance method. Okay, let's calculate the depreciation on furniture and equipment. This is the reducing balance method, so we require our net book value. And in this case, we have been given the carrying value itself, which is the net book value. That's 956,000. So 956,000 multiplied by the rate for depreciation, 20%. This gives the total depreciation charge for the year to be 191,200. Then depreciation charges should be allocated 60% towards administrative expenses, 40% towards distribution costs. Okay, let's divide it. Now towards administrative expenses, we need 40% of this amount. 60% of this amount. So that will be 191,200 times 60%, which results in the value of 114,720. Let's add this amount to the given balance for administrative expenses, which is right here. So we just add the value of 114,720. Then for our distribution cost, we require 40% of the same amount now. That will be 191,200 times 40%. And this results in the value of 76,480. Let us add this to our distribution costs. So distribution is right here, plus 76,480. So we have included the depreciation for our furniture and equipment. Then at 31st December 2023, the office wages of 5,800 were due but unpaid. So it means that we have office wages of 5,800 accrued at the end of the year. But still, this 5,800 is still the expenses for the current year, which is why we need to add it now. Let's add this towards the office staff. That will be plus 5,800. Then the debentures have been issued on 1st October 2023. The first interest payment is due on 31st March 2024. So for our current year, the ending date is 31st December 2023, which means that this debenture has been used for the months of October, November, and December. So we need to calculate the interest on the debenture for these 3 months. Let's calculate it. So we have our debenture amount of 240,000. The rate of interest is 8%. So the interest charge is just going to be 240,000 multiplied by the rate. But this will give the annual interest, which is the interest for 12 months. But in this case, we only require the interest for the 3 months. So times 3 by 12. This will give the interest on debenture to have a value of 4,800. Then tax for the year ended 31st December 2023 is estimated to be 27,900. Okay, that is all the given information. Now we need to prepare the statement of profit or loss for the year ended 31st December 2023. You need to use the space provided on page 4 to show your workings, but I will be doing all of my workings within the question itself. Make sure you guys present those workings in the given box to get your markings correctly. Now, the first item is our revenue. Let's take a look above. We have revenue right here, and in this case we've already concluded that there is only purchases returns, so we do not have to worry about any sales returns for revenue. We can just enter the value of 997,100. Now we need to calculate our cost of sales. Okay, I'll calculate it right here. We know that for cost of sales we start with our opening inventory, which is given right here. The value is 47,800. Then we need to add the purchases made for the year. And the purchases is also given right here. The value is of 522,000. Then if there is any carriage inwards, we need to add it, which it is in this case. We have the value of 4,500. And remember, we also have the purchases returns, so that should be subtracted, and the value for purchases returns is 5,100. And after this, we just have to subtract our closing inventory. The value for closing inventory is 49,500. This gives the value for our cost of sales to be of 519,700. Let's write it down. Now we need to calculate the gross profit, which is just the difference between the revenue and cost of sales. That gives us the value of 477,400. Now we need to add other income. So the other income in this case was our rental income. Let's see, for rental income it's given right here. It is 13,300 minus 3,000. So that gives us the value of 10,300. And let's see, the income will be given on the credit side for our trial balance. So in this case, I don't think we have any other incomes apart from our rental income. Yeah, that should be all for our other incomes. We just need to include the value of 10,300. Now we have the distribution costs. So we have made some adjustments to the distribution costs. We have made adjustments for the closing prepayment and then included the depreciation on furniture and equipment. Now we also need to look for any other distribution costs. Let's start from the top. So we have the administrative expenses. That's a separate heading itself. We have bank loan interest. So any interest will always be a part of our finance cost. So this will not be included within the distribution cost. We have carriage outwards, which will be included as part of our distribution costs. Let's add the value of 8,700. Then we have the dividends paid. That will not be included within our statement of profit or loss. We have the retained earnings, share capital, share premium, trade payables, trade receivables. We have the wages for our sales staff, which is also part of the distribution cost. So we need to add this value of 38,300. Okay, so that should be all. Let's calculate the total. That will be 30,700 minus 6,000 plus 76,480 plus 8,700 plus 38,300, which gives the total of 148,180. That's the total for distribution costs. And we need to subtract it. So 148,180. Now we need to include the administrative expenses. So for administrative expenses, we have already made an adjustment right here. That is for the depreciation charge for the year. Then I think the only one to be included now will be our wages for the office staff. And that's 49,300 plus 5,800, which gives a total of 55,100. Now we need to add it to our administrative expenses. Now the total administrative expenses is just going to be 17,200 plus 114,720 plus 55,100, which results in 187,020. Let's write it down. 187,020. Now the profits from operations is just the sum of these four values. So 477,400 plus 10,300 minus 148,180 minus 187,020, which results in 152,500. Now we need to include the finance cost. Finance cost is just the total of our interest payments. So we have interest on two different things. The first one is the interest on debenture of 4,800. Then we have the interest on bank loan right here. So the total finance cost is just going to be 2,600 plus 4,800, which results in the value of 7,400. Let's write it down. Now we need to calculate the profit before tax, which is just the difference between profit from operations and the finance cost. That's 152,500 minus 7,400, which results in 145,100. Now we need to subtract the tax. And the tax amount was clearly given right here. That was 27,900. And finally, we need to calculate profit for the year, which is the difference between profit before tax and tax. That's 145,100 minus 27,900, which results in 117,200. This completes the statement of profit or loss. Let's move towards the next part. Now we have been given additional information. During the year ended 31st December 2023, the following transactions had been recorded in the books of accounts. At the date of 1st September, a rights issue had been made of 1 ordinary share for every 3 ordinary shares currently held. The issue was made at a premium of 0.05 per share. The rights issue was fully subscribed. Okay, it had been made 1 ordinary share for every 3 ordinary shares held. So for every 3 ordinary shares in the business, we made 1 rights share or 1 rights issue. And now let's see. The total number of ordinary shares is 4 million. But also remember that this is at the closing date. So this is after the issue of rights shares. So the total number of ordinary shares plus the rights shares is 4 million. And we know the ratio, right? For every 3 ordinary shares, there is 1 rights share. So we can just divide this value of 4 million on the basis of this ratio in order to get the starting balance of our ordinary share and then the number of rights shares as well. So for our ordinary shares, that is just going to be 4 million times 3 by 4, which is 3 million. And the number of rights shares will be 4 million times 1 by 4. That's 1 million. Now for the value, we need to multiply it by the nominal rate. And the nominal rate for our ordinary shares in this case is 0.25. So the value for ordinary shares in this case will be the number of ordinary shares. So that's 3 million times 0.25, which results in 750,000. Then the value of rights shares to be included within the ordinary shares itself will be our number of rights shares, so that's 1 million, times 0.25, which results in 250,000. And also remember that this rights issue was made at a premium of 0.05 per share, which means that the premium aspect for this rights issue will be the number, again, that will be 1 million, multiplied by the rate of premium, which is 0.05. So that gives us the value of 50,000. Then at the date of 31st December, property had been revalued and the value reduced by 60,000. So in this case, 60,000 is the revaluation downwards. We need to subtract it from our revaluation reserve. Now we need to complete the statement of changes in equity for the year ended 31st December 2023 on page 5. Okay. So right here we have the balances at 31st December 2023. Now for our share capital and share premium, not for share premium, just for the share capital, we calculated the opening balance of the ordinary shares, right? That will be 750,000. Then there was a rights issue. From this rights issue, our ordinary shares will increase by 250,000, whereas the share premium will increase by 50,000. So 250,000 and 50,000. In total, that will be 300,000. Now, I don't think there will be any other transaction for share premium, so we can just calculate the opening balance by creating an equation here. That is, opening balance plus the 50,000 from our rights issue will result in the closing balance of 215,000. This means the opening balance is just going to be 215,000 minus 50,000, which gives us the value of 165,000. That's the opening balance. Now we need to record any other transactions during the year. Okay, in this case, property had been revalued and the value reduced by 60,000. So there is a revaluation downwards. And revaluation downwards should always be subtracted from the revaluation reserve. And in this case, the revaluation downwards was of 60,000. And we can see that the opening balance is also 60,000. So the entire revaluation downwards can be sustained by the revaluation reserve itself in this case. And we can see here as well the closing balance is 0 because the entire 60,000 has now been subtracted. We are also given information regarding dividends paid in this case. And dividends paid should always be subtracted from the retained earnings column. Let's take a look above. For our dividends paid, it's right here, the value is 37,500. Now we just need to subtract this from the retained earnings. So 37,500. And lastly, we need to add the profit for the year. We just calculated the profit for the year in the first part to be 117,200, and we always add the profit for the year to our retained earnings. So again, 117,200. Alright, first of all, let's calculate this total value for our opening balances. That will be 750,000 plus 165,000 plus 60,000 plus 174,000, which results in 1,149,000. Okay, for revaluation, the total is 60,000. Now the closing balance for the retained earnings will be 174,000 minus 37,500 plus 117,200, which results in 253,700. Then the closing balance for our total will be 1,149,000 plus 300,000 minus 60,000 minus 37,500 plus 117,200, which results in 1,468,700. That's all for our statement of changes in equity. Let's move towards the next part. We now need to say two factors that the directors should take into account when declaring a dividend. So for dividend, the two factors to be considered is our cash available within the business and the available balance of our retained earnings. Let's write it down. So availability of sufficient cash and the available balance of retained earnings. And this is because cash is required in order to pay out the cash dividend to our shareholders, whereas the balance of retained earnings is required because we can only pay dividend from our revenue reserve, which is the retained earning and the general reserve itself. That is all for the third part. Let's move towards the next one. We now have additional information. The directors wish to improve the company's performance. They are considering two options. The first one is to delay payments to credit suppliers by an extra 8 days. It means that the cash will remain within the business for an additional 8 days now. Option B is to switch to a new supplier who is prepared to offer a trade discount if large orders are made. We now need to advise the directors which option they should choose. We need to justify our choice by considering the effect on both profitability as well as liquidity. Okay, and this question is of 7 marks, so we need to have 3 comments for each of the options and one final decision. Let's start with the comments for option A. The first thing we can write down is that delaying payments might worsen the relationship with the suppliers, and as a result, the supplier might increase the cost or maybe tighten their credit terms. Let's write it down. Delaying the payments might worsen relationship with the supplier, resulting in higher prices, and this would lower the profitability of the business. The next thing you can write on liquidity is that if we delay the payments by an additional 8 days, then that will improve the cash flow of the business because the cash will now remain within the business for an additional 8 days. So the delay in payment will improve cash flows. But since we are now delaying, the suppliers might choose to withdraw the credit terms or tighten their credit terms, which will further deteriorate our cash flow position of the business. So some suppliers might withdraw the credit terms which will further deteriorate the liquidity. Now we can move towards the comments on option B. For option B, we are switching to a new supplier. Since this is a new supplier, we can always question the reliability. Because if the supplier is not reliable, meaning that if the supplier does not provide us with timely deliveries, then it might result in possible reduction in profits. So will supplier provide timely deliveries as failure to do so might reduce profits. And in this case, since we are now getting a trade discount on large orders, this will improve the cash flows because essentially our cost of purchase has been reduced due to the reduction in cost of purchase. Cash flows will improve. And since we are again talking about switching to a new supplier, we can always question the quality of goods that they will provide. If there is a reduction in quality, then it might drive some of the customers down, which will reduce our profit as well. So possible reduction in quality which will drive down the customers and further reduce profit. Now, based on these factors, we need to make a final decision. So personally, I would advise the directors to go with option B because this will improve profitability as our cost of purchase is now reduced. Let's write it down. The directors should choose option B as it will improve profitability due to the reduction in purchase cost. That is all for the fourth part as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.